Selling tangible assets. Tangible assets owned by a business might be sold because either they become too old or they might incur very high maintenance costs and the business might prefer to buy assets that have a service plan, for example. Alternatively, they might simply be no longer useful and then the business has no need of them and it makes more sense to sell them. Remember from last year when you recorded depreciation, the accounting records reflect the cost price in the asset account and the accumulated depreciation in a separate account. When you sell the item, both of these need to be removed when the asset is sold, as you no longer have the asset, so it no longer has a cost, and there is no longer accumulated depreciation associated with it. The asset might be sold for its book value, in which case it's the cost less the accumulated depreciation as calculated by the business. However, in practice it is usually sold for slightly more or slightly less, which would incur either a profit or a loss, depending on the way in which the asset was sold. In order to simplify matters, an asset disposal account can be created to help you record the sale of the asset. The existing accounts are then cleared out to this account and the profit or loss is easily calculated. All of these transactions would be recorded in the general journal, unless the asset is sold for cash, in which case the entry for the selling price may be recorded in the cash receipts journal. If you look at this illustration, you can see the asset disposal in the middle is showing how the asset is going to be recorded when it is sold. The asset account itself is credited with the cost price of the item that you had when you first bought it. This is then shown in the asset disposal account to take the cost price into account. If you think of your Smarties activity, this would be the 5 Smarties that the asset was originally worth. You will then look at the accumulated depreciation relating to that asset at this time. In your Smarties activity, these are the jelly tots that you had depreciated your asset by. This is then closed off to asset disposal on the credit side. You can now easily see in one place how much your asset is actually worth. You will then need to take into account your selling price of the item. This might have been for cash, in which case you would use bank. If you sold it on credit to a debtor, debtors would be your other account. Maybe you traded it in which case it would be creditors against the cost price of the new item. Other accounts might also be used, for example, drawings if your owner took the asset. You will simply need to look at the information given very carefully and decide what the other account would need to be. Now that you have your selling price included in your asset disposal account, you can work out whether a profit was made or a loss. As you can clearly see here, if your selling price and your accumulated depreciation together are more than what the asset originally cost, you would have made a profit. On the other hand, if you received too little, you would have made a loss. If you made a profit, this would then be shown in the profit account on the credit side. Remember that a profit account increases equity, and that is why it would be credited. Obviously, the converse of that is if a loss was made, you would debit the loss account. Let's have a look at the example. Imagine that a computer that originally cost 10,000 Rand is sold. We are given the cost price of 10,000 Rand. This would have been included in the balance brought down for equipment, but we only take out the cost of the asset that we sold. This will be brought down into the asset disposal account, shown on the debit side. We are then told that it was sold for 4,500 Rand cash on the 1st of July. There are 2 pieces of information here that are important. The first one is obviously the selling price, which means that bank is going to be debited with that 4,500 Rand because it tells you it was for cash. And you can show this on the credit side of asset disposal as the selling price. The second piece of information you need to use is the date of the sale, in this case, the 1st of July. We are then told that the accumulated depreciation to this date amounted to 6,000 Rand. Again, that 6,000 Rand would have been included in the balance brought down in accumulated depreciation on equipment. However, we only need to remove the 6,000 Rand that relates to the asset that was sold. This is then transferred to the asset disposal account. You can now see that your equipment and accumulated depreciation accounts have been cleared out. Bank does reflect the amount that you received, and in your asset disposal account, you can now easily work out whether you made a profit or a loss. In this case, a profit on sale of the asset was made because you received more than the carrying value of the asset. Now go and do 5.4 exercise before marking it carefully.